Okay, welcome back to another lesson. In this video, we are going to revise an exam that was done in April 2023, and we are going to begin with question number 1. And the question reads, that is question number 1A. The management of a limited liability company is appointed to promote and protect shareholders' interests in the performance of their function. The aim is to maximize shareholders' value. The management, however, could have interests that might be in conflict with the shareholders' interests. In reference to the above statement, you are told identify the type of conflict in modern day financial management of a firm. What kind of conflict that exists in modern day financial management? The major conflict of interest here is what we call the agency problem. Is what we call the agency problem, where an agent is appointed to safeguard the agency problem. An agent is appointed to safeguard the interests of the principal. In such a case, many agents tend to maximize on their interests than the interests of the principal. So the agency problem is the major financial management conflict. Now, 2, you are told explain 3 factors that could contribute to the conflict identified above. What can cause the agency problem? 1, we can have management may use corporate resources for personal use. When they are left to safeguard the resources of the company, they may end up using it for personal gain. 2, management may take holidays. Management may take holidays and spend huge sum of company money, You see, at the end of it all, they are able to account it as expenses. Yeah, so that is another factor that contributes to agency problem. Another one is creative accounting. Here we say that it involves manipulation of finances. Manipulation of financial information or financial data. Involve manipulation of financial accounting or finances. Creative accounting. You overstate expenses or understate expenses to create a profitable business. Another problem here is empire building. Empire building. Here saying that managers may organize Managers may organize for mergers, beneficial to themselves, are not shareholders. Lastly, we say that failure to declare dividends, for no good reasons. So that is it. Those are some of the factors that may contribute to urgency problem. We move on to the next question. You are told, as a financial management professional, explain 4 strategies that could be used to manage or mitigate this conflict to protect shareholders. So you're saying that strategies that could be used to mitigate conflict to protect shareholders. To mitigate conflicts to protect shareholders. This strategy could be 1, performance-based remuneration. This involves remunerating management. For actions they take to maximize shareholders' wealth. To maximize shareholders' wealth. Number 2, or let me call it B, we are saying incurring agency costs. By this we mean that agency costs are those incurred by shareholders in trying to cut management behavior. And actions that, and therefore minimizing the agency conflict. And therefore minimizing the agency conflict. The cost in this case can be having a regular external auditor visiting the company, having management headed by an outsider, having so many other costs that can be incurred to ensure that the conflict of interest is managed. Number 3, we are talking of direct intervention by shareholders. Direct intervention by shareholders. Here, we mean that this may be done in the following ways. This may be done through the following ways. Through the following. Shareholders can make a recommendation. This is making recommendation to the management on how the firm should be run. Making recommendation to the management on how the firm should be run. Another way is by threat of firing the management. Threat of firing. So in this case, the shareholders can come in and protect the agency conflict. And the last one, we can talk of threat of hostile takeover. Threat of hostile takeover. We are saying that this may be managed by the shareholders. This may be arranged by shareholders to lock out management, who aren't responsible, So these are ways in which shareholders can intervene. We are saying that the strategies which shareholders can use so that they mitigate the conflict of interest. And here the conflict of interest, you're talking about management taking their own interest at the expense of their shareholders, who are the contributors of the capital. You see, the management, the agency theory state that the management are responsible to the principals, who are the shareholders. And therefore, in a situation where there is a conflict of interest, it is wise for the shareholders to intervene and make corrections where necessary. Now, that is it about part 1, about the conflict of interest. We go to part 2. Part 2 reads that CPO Limited is evaluating an investment project which requires the importation of new machine at a cost of 3,700,000. The machine has a useful life of 6 years and a salvage value of 1 million. Additional information. The following additional costs will be incurred in relation to the machine. There will be modification costs at 1 million, import duty 900,000, installation cost 375,000, freight charges. Additional information 2. The machine is expected to increase the company annual cash flows before tax as shown below. Those are the cash flows. Beginning the year 1, year 2, and these are the figures. 1, 2, 3, 4, 5, 6. These are the figures down here. Only that they have slightly moved forward. The machine is to be fully depreciated over its useful life using a straight line method. The corporate rate of tax is 30%, while the cost of capital is 10%. 1. The maximum acceptable payback period for the company for all projects is 4 years. You are required to determine the initial cost. Here, what we do here to find the initial cost is we capitalize expenses. Those expenses like import duty, freight charges, you capitalize them to give you the initial cost. So let's look at the initial cost. 1, there is the purchase cost. The purchase cost of 3,700,000. Then you get modification costs. Modification cost 1 million. All those other expenses come in shortly after the purchase, before the machine is settled for use. Those ones, they are capitalized. Import duty. Import duty, here we have 900,000. Then we have installation cost. Installation cost. Installation cost is 375,000. And finally, we have freight charges. Freight charges. Freight charges here is 225,000. When you add all these, as from the question here, I said you capitalize this cost. This initial cost before the machines get into use. When you add all this, you find that the initial cost is 6,200,000. That is it about the initial cost. Next, you are told you determine the annual net cash flows. The net cash flows here means that you have to consider the effect of depreciation on your cash flows and the taxes. So let's determine the annual net cash flows. And before that, you have to look at what is the value for depreciation. You are told that there will be a scrap value of 1 million. So you shall have 6,200,000 minus the scrap value, then divide by 6. This gives you depreciation of shillings 866,667. Annual depreciation will be this, because you look at this question, you're told that the machine has a useful life of 6 years and the salvage value of 1 million. The salvage value here is what I've captured here. Now, let's now determine the cash flows. We have the years, there are 6 of them. We have 1, 2, 3, 4, 5, 6. And increase cash flows. They are already given in the question. Here we have 1760, 1360, 1050, 900, 840, 750, and they're in thousands. So because they're in thousands, I can just write 1,760,000. Here I can write 1,360,000. This is 1,050,000. Then I have 900,000. I have 840,000. And finally I have 750,000. I just copied the values as they are in the question. These figures here, they see they were in thousands here. Now, then we less depreciation. Depreciation is an expense. Less depreciation. That is 866,667. 866,667. 667, 866, 667, 866, 667, 866, 667. Depreciation is annual depreciation. Now, once you less depreciation, you are going to get what we call profit before tax, PBT. PBT, profit before tax. You're going to get profit before tax. You take 1760 minus 866. This will give you 893,333. This one will give you 493,333. This one will give you 183,333. Then this one will give you 33,333. And this is negative. The depreciation is more than the cash flows. You have negative 26,667. Similarly here, depreciation is more than the cash flows. Negative 116,667. So that is what we call profit before tax. Yeah. Then I have to get the tax now. So here we less tax. Less 30% tax. You less 30% tax. So 30% is on profit. Take 30% of 899,333. This gives you 268,000. 30% of 493,333. This gives you 148,000. 30% of 183,333. This gives you 55,000. This will give you 55,000. 30% of 333. That will give you 10,000. Will give you 10,000. 30% of negative, this will be negative 8,000. This one here will be negative 8,000. And 30% of 116, this will be negative 35,000. Now, let's now get profit after tax. Let's now get profit after tax. Subtract the tax. This tax you subtract from the profit before tax. 893,333 minus 268. Here you get 625. 625,333. This one will give you 349. When you subtract 493,33, this one you subtract from this, you get 333. Then this will give you 16, 13, that is 5, and then this is 8, 4, 345, 333. This will give you 128, 333. This of course is 23, 333. Negative and negative. When you minus means this one becomes positive. And this will give you negative 18. Negative 18, 667. And similarly here, when you're minusing twice, it means it will give you positive. This is 81, 667. Correct. Those are now what we call profit after tax. This is profit after tax. I've subtracted depreciation, I've subtracted tax, but remember, depreciation does not involve the movement of cash. So I add back depreciation. Depreciation add. After profit after tax, you add depreciation because depreciation does not involve the movement of cash. That is 866,667. 866,667. 866,667. 866,667. 866,667. 866,667. Now, what do you get here? So here you get what we call annual net cash flows. Annual net cash flows. We shall have, add these two, you get 1,472,000. 1,212,000. And then we have 995,000. Then you add this one, it will give you 890,000. Add these two, we'll get 848,000. And finally add this, you get 785,000. Remember, this was negative. The reason why the figures have reduced. Now, at the last year, there will be a salvage value. Salvage value. The salvage value comes for the last year. The last year, there will be a salvage value of 1 million. So therefore, we can now conclude and say this will be the net cash flows. This cash flow here does not change. 1,472,000 does not change. This is 9, sorry. This is 492,000. Does not change. The same here does not change. The same here does not change. Similarly, here does not change. Here does not change. But the last year will change to 1,785,000. So those are the cash flows. Those are the cash flows that the company will have. The annual cash flows. Now, next you are asked, you look for the payback period. Remember, the benchmark period here is 4 years. So we have to check, does our cash flows meet the payback benchmark. So we look at the payback period of the machine. We shall have the year, and then we shall have the cash flows, and we shall have cumulative cash flows. Cumulative cash flows. Here there are 6. 1, 2, 3, 4, 5, 6. The first one is 1,492,000. Then we have year 2 is 1,212,000. Year 3 we have 995,000, 890,000, and then 848,000. And the last year is 1,785,000. Cumulative cash flows, we have 1,492,000. You add this, gives you 2,704,000. Then add this to this. Your cumulative means you add 2,704 plus 995. This will give you 3,699,000. Add 890, gives you 5 million. This is no, not 5 million. It should be 4 million. This plus 890, that should be 4,589,000 plus 848. This will give you 5,437,000. And finally, we have 7,212,000. 222,000. Now, let's determine the payback period. You see, we need, the machine will have an initial cost of 6 million from what we calculated here. The initial cost is 6.2 million. So we need to recover that period. And you see, how long does it take to recover that period? If you look at this, we take the 5th year, we shall only have recovered 5 million for that 7,000. So 5th year, we shall have recovered a payback period. In 4th year, 5th year, we shall have recovered 5 million, but the 6th year, we shall have surpassed the 6.2 million. So we need to know how long does it take after 5th year. We take 6,200,000 minus 5,437,000 divide by, we divide by the amount which is being gained in that year 6, which is 1,785,000. So this gives us 5 plus 0.5 plus 0.43. That is 5.43 years. It therefore means that the company will take 5.4 years to recover their money, which is 6.2 million. Now, according to the benchmark requirement from the question, you are told that the maximum acceptable payback period for the company for all capital projects is 4 years. But this project will take 5 years. So what do you advise the company to do? The company should not import the company should not import the machine since it has a negative net present value. Since the company should not import the machine since the payback period is more than the benchmark, period of 4 years. Benchmark period of 4 years. The payback period here is 5.43, but the company requires a machine to pay back. I mixed that one. The payback period was coming part 4. The payback period was coming. This part here, we were to look for the net present value. Yeah. After finding this part here, we have to look for net present value. This is not point to advise the company here. Although the advice still holds in the last part here. Here we are to look for net present value. After having found the payback period, we now discount those cash flows in the next part here. I had gone to advising the company based on the payback period. But here we are supposed to look for net present value. Now, how do you discount? What is the discount rate? Go back to the question. You are told that the corporate tax rate is 30%, while the cost of capital is 10%. So here in this part here, we have to discount. Let's discount the cash flows. Yeah. Discount the cash flows. We have year 1, 2, 3, 4, 5, 6, and then the cash flows. The cash flows, we had 1,492,000. Then we had 1,212,000, and then we had 995,000, 890,000, and 848,000, 1,785,000. We look for present value interest factor at 10% because that is the cost of capital. The first year is 0.9091, then next 0.8264, then here we have in 0.7513, and then this 0.6813. How do you find this? At this point, I tend to believe you know how to get the PVIs. These ones, they are obtained directly from the financial table. Here we have 0.6830. Then here we have 0.6209. Then 0.5645. Get the product of cash flows and the PVIFs. 1,356,377.20. They get the product of these two. You will get 1,001,596.80. The product of these two give you 747,543.50. The product of 890 at 0.68, you'll get 523.20. And then here we have the product of 843. When you take the product of 890 and 0.6830, you get 607. This 607,870.00. And then this one will give you 523.20. This is 6. And finally, get the product of these two. You will get, this is 1,007,632.20. You add all of them. Add all these, they give you 5,247,543.20. That means you are getting the sum of the present values. But what is the initial cost? Initial outlay is 6.2 million. 6.2 million. 6.2 million. When you subtract this, it means that you're going to have NPVs. The net present value is negative 952,456.8. Then this is when you are told, advise the company management on whether to import the machine based on your result B3. This, you see, this is B4. B4. You are told based on the result of B3 and B4. This is B3 and this. So the B3 is about the payback period and the B4 is about the net present values. So what, based on the payback period, what will you advise the company? So I had written this one before. We say that the company should not buy or import. The company shouldn't import the machine. Shouldn't import the machine since it has a negative. Since it has a negative NPVs, and the payback period, is more than the benchmark, and the payback period is more than the benchmark period of 4 years. Benchmark period of 4 years. So that is it. That is how you are to solve this question. And we are going to stop there. Meet in our next video. For now, we say is a goodbye.